rather alarming turn of events, U.S. banks are gearing up to sell property loans at discounted rates, even when borrowers remain up to date with repayments. This raises a significant red flag, indicating an impending plummet in property values. The commercial real estate sector finds itself in deep trouble, with reports suggesting that one hedge fund manager has even proposed demolishing properties due to the unfeasibility of converting them into apartments. In this video, we delve into the intricate details of the commercial real estate market, shedding light on the current situation. If you crave more content like this, make sure to subscribe, leave a comment, and share your take on the matter. Complexity unveiled. According to the Financial Times, commercial real estate is poised to become the next shoe to drop, prompting banks to scramble and offload their portfolios at discounted rates. Banks are increasingly averse to lending to property developers, exemplified by SBC USA, which is in the process of selling hundreds of millions of dollars worth of commercial real estate loans. Similarly, just last month, PacWest sold approximately $3 billion worth of construction loans at a loss. Banks are opting to incur these losses now, rather than bearing the burden of potential delinquencies in the future. The scale and urgency at which banks are divesting themselves of commercial property debt is deeply concerning, as it is an unusually drastic move, signaling their expectation of even larger losses if they retain these loans. The looming threat for small and regional banks. Perhaps the most worrisome aspect is the significant role small and regional banks play as the primary source of credit for the colossal $20 trillion commercial real estate market. These banks hold approximately 80% of the outstanding debt in this sector. This revelation makes it crystal clear that the banking crisis is far from over, and we should anticipate more consolidations as these banks grapple with their commercial property portfolios. The inevitable fallout from this situation will undoubtedly have profound repercussions. Unraveling the bank's perspective. On the surface, it seems illogical for banks to shed loans that are technically not delinquent, especially considering borrowers are diligently making their payments. However, lenders now believe that these borrowers will face significant challenges in the near future. Banks have deemed lending to them too risky and prefer to incur losses immediately rather than deal with potential delinquencies down the line. The rush to divest commercial real estate debt stems from the impending maturity of nearly $1.5 trillion in commercial mortgages over the next 3 years. Banks anticipate that many commercial landlords will be unable to refinance at higher rates, leading to widespread failures. Beyond commercial real estate, a broader banking crisis. While we focus on commercial real estate debt, it's crucial to note that banks have been bolstering their reserves across the board. Household debt is skyrocketing, with an increasing number of consumers falling behind on new vehicle payments, and credit card interest rates surpassing 20%. It is merely a matter of time before we witness a surge in consumer delinquencies. Navigating regulatory concerns. From the bank's perspective, it becomes imperative to appease regulators and investors by showcasing favorable financial results. David Avram, a principal at Maverick Real Estate Partners, a private fund specializing in commercial real estate loans, asserts that banks are cautious about raising concerns among regulators or investors. Regulators seek reduced exposure to commercial property, which explains the urgency behind the bank's actions. The dire state of commercial real estate. The National Association of Realtors reveals that commercial vacancies have reached an all-time high, surging to a record 12.9% in the first quarter. This spike is primarily attributed to the work-from-home trend that shows no signs of abating. High-value properties, often associated with above-average rent, have an alarming vacancy rate of 17.9%. Houston, Dallas, Fort Worth, and San Francisco are particularly affected by rising office vacancies. The commercial property market, especially the office sector, grapples with two significant challenges: escalating vacancy rates and declining property values. Some predictions even claim that the crash in the commercial real estate market may surpass the severity of the 2008 financial crisis, with office and retail property valuations potentially plummeting by up to 40% this year. Refinancing nightmares and tighter lending standards. Morgan Stanley and other experts anticipate that over 50% of the $2.9 trillion in commercial mortgages will require renegotiation within the next 24 months. However, during this period, new lending rates are projected to increase by 350 to 450 basis points, rendering refinancing significantly more challenging. Moreover, new, stricter lending rules and standards further complicate matters. As debt matures in the coming years, not all businesses will be able to handle the situation, especially considering the prevalent work-from-home policies that have diminished the need for physical office spaces. Consequently, many companies may opt not to refinance or choose substantial downsizing measures. Vacancy rates are expected to surge further, and commercial office property values are likely to continue plummeting due to an oversupply and insufficient demand. Conclusion: the specter of a colossal crisis looms over the commercial real estate market, compelling banks to sell property loans at discounts and raise concerns about the stability of small and regional banks. While the specific motivations behind these actions may seem perplexing, the anticipation of delinquencies and the staggering volume of commercial mortgages coming due explain the bank's urgency. As vacancy rates soar and property values decline, the commercial real estate market finds itself in a precarious state. The impending refinancing challenges and stricter lending standards further exacerbate the situation, posing significant risks for businesses and financial institutions alike. Brace yourself for the aftershocks of this crisis, and let us know in the comments how you believe the office real estate crash will impact small and mid-sized lenders. Your thoughts are highly valued and appreciated.
Thanks for watching. If you found this video helpful, please consider subscribing for more content. Take care.